Hello guys, today we're going to be talking about 8 things I wish I knew before I started investing that you should know before you started investing. Going on to the very first one, research your brokerages. Well, it's no surprise to anybody that brokerages have promotions for their products. A lot of the times you'll see this on financial YouTube people or see them in sponsorships in these videos that you're watching. That's great and all, and these promotions are something to take advantage of, but before you go just downloading things that have the first promotion in sight, research your brokerage, or research the brokerage you're interested in. This is something that people overlook. It's the very first thing you have to do to start investing, so don't overlook this one. Make sure you look past the promotion into what they're selling, what their rates are, and stuff like that. But make sure you research your brokerage. It's the biggest mistake people make when they start investing. Number two is don't let day trading media fool you. A lot of the times, this goes with researching your brokerages, honestly. A lot of the times, people will try to fool you with day trading media. Like, oh, you can make 1,000 to 1,500 a day. Yeah, you can, but you're gonna lose your money because if 80% to 90% of the pros can't do it, which are just numbers I made up, but most people can't do it and they end up losing their money in the long term, you probably won't. Not to mention, day trading has a lot of tax implications. That have a lot of tax implications, so it's just not advantageous for the starting investor and or for a seasoned investor because you're paying basically the same you would on just generated income instead of like long-term tax advantage accounts. Okay, the third thing you should know is to watch out for fees. When you start broad market index funds or ETFs, exchange traded funds, you'll have a whole array of different top market ones from like Fidelity, Vanguard, some other ones that just track a market. And that's what you should be investing in, is broad market ETFs and index funds, because it's the safest and it will perform with the market. You can't beat the market, but you will at least perform with the market at first. And that's a good stepping stone. But what you need to watch out is those fees, because a lot of ETFs and index funds have higher fees than a different one that does the exact same thing. Obviously, take this with a grain of salt. You want one that's at least reputable. You don't want one that doesn't have a good track record, obviously. So just research the fees and know what the fees are. Number 4, everybody does this at first, at least they think they can do this at first, and that is don't time the market. There's always good or bad times in the market, but you don't really know when a good or bad time is in the market until after it's over. If you just take your money and put it in the market over a long period of time, you're going to do a lot better than somebody that's trying to time the market, because they're missing out on dividends. They're missing out on that one day that just shot up out of nowhere. They're missing out on a bunch of things that you just can't really track. So don't time the market when you start out. Number 5. This is something that people think that they can make tens of thousands of dollars really quickly on the stock market, and they can, but investing overall is normally a long time ordeal. You invest in a company and you wait for that company to grow, and then you take out your money. It's a long-term thing. We're talking about like 3 to 5 years at least, and after 3 to 5 years you're going to have better taxes on those gains or losses. You can take losses too. We'll talk about that later. But just know that if it's a long-term deal, you'll get better off by the tax man. Tax man loves when you put money in a market for a while, not day trading, like I said earlier. Number 6, along with the earlier one, like watching your fees and stuff, don't stock pick. Stocks don't really have fees. If you just choose a Tesla stock or something like that, it doesn't have a fee. It's not like an index that tracks a market or an ETF. It doesn't have a fee, so you don't have to watch out for fees. But when you stock pick, most of the time you lose. And I think you'll see in all these different financial YouTubers, I think they said like 90% of market hedge fund managers don't perform as good as the market, or they perform as good as the market and a little bit more, but that just goes to fees. So don't stock pick, because if the hedge fund managers can't do it, likelihood is, as a beginning investor, you probably won't do it either, because they have degrees and they know what they're doing. So just don't think you're better than hedge fund managers at first, at least, but don't allocate all your assets into stocks, especially individual ones. Okay, number 7 is something that you don't really want to plan for, but you should know is there. Number 7 is learn to optimize your losses. When you're in the stock market, inevitably you'll choose something that doesn't do well, as long as you're stock picking, which you shouldn't do. But if you do stock pick, learn to optimize your losses. If you lose $2,000 in the stock market, you can take that off your taxes for the year. So learn to do that. Learn to do what the rich people do, and is learn to optimize losses. And that's how they don't pay so little. They don't pay taxes, because they learn to optimize their losses. You can do this too on a much smaller level. I think $2,000 a year you can take off your taxes by losses. Obviously, don't try to lose. It's not smart, but just learn that you can do that. Number 8 on this is what I wish I knew, and you should know, is you should always dollar cost average in the market, dollar cost average out of the market. The first one makes sense. A lot of people dollar cost average in, and that basically allows you to take away some of the volatility of the market. Like, you're not going to be investing on the worst day or the best day, or you're going to be investing on all the worst and best days, so it kind of just takes out that big fluctuation or volatility of the market. Like, oh, I invested $50 a week every week on Monday. That just takes away, like, oh yeah, I invested on the worst day, but I also invested on the 3 best days, or vice versa. It just takes out some of the volatility. But if you dollar cost average in, make sure you dollar cost average out. That way you ensure that you're not taking the least amount that you can or the best amount. It just kind of like takes out and makes it an average. And it honestly helps a lot. So a bonus tip for people that made it this far is don't listen to the media. When I say media, I don't only mean Fox News and CNN and all that types of stuff. I mean YouTubers is included, myself included. Take us with a grain of salt, or just give us a little bit of a smidge of doubt, because a lot of the times people try to sell you what's the worst, because people like hearing doom and gloom to media. You're gonna tap on something that it's like, oh, the world's ending. It's because it's more interesting than somebody being like, well, the stock market's gonna stay the same for the next 10 years. Maybe you'll get a 5% raise or whatever. Alright guys, that's all for this video. So if you like this video, go check out my other content. Up above, I'll have a video series of Secrets of the Millionaire Mind by T. Harv Eker. And as always, take care and peace.